Tax tips for capital gains, what you need to know in 2022. Tax season is here, and it's time to think about your taxes. Capital gains, or the profit from the sale of a capital asset, are subject to taxation by the federal government and state governments. With all the new tax laws going into effect, including a new federal tax law that impacts capital gains taxes, you need to know how these changes will affect you. Here are some important things you need to know about capital gains taxes this year. What is a capital asset? The definition of a capital asset is anything that has value and produces income. So, for example, if you have stocks, your stocks are considered to be capital assets. If you have a business, the building where your business operates is considered to be a capital asset because it generates income. Why are capital gains taxable? Capital gains are taxable because they're considered as part of your income. If you make more than $400,000 a year, then 30% of your capital gains will be added to your income. For those who make less than $200,000 a year and don't make any capital gains, there's no change. How does the new tax law impact capital gains taxes? One of the major changes that the new federal tax law made to capital gains taxes is lowering the rates. The new law has 3 brackets for capital gains: 0%, 15%, and 20%. This lower rate, which starts at $38,600 in taxable income for individuals and $77,200 in taxable income for joint filers, will be a huge help to taxpayers. Additionally, the new tax law put an increased focus on indexing capital gains to inflation. Before this change, investors were responsible for calculating and reporting their inflation adjustments when filing their taxes. Now, indexing will be automatically applied if you use your assets, such as stocks or bonds, to determine your net long-term capital gain or loss. Indexing the revenue will ensure that taxpayers are not faced with unexpected inflation-related tax bills. When do I have to pay capital gains tax? The tax is due up to the date of the sale, not on your end date. The tax is usually due by April 15th following the fiscal year in which you made a capital gain. How can I calculate my capital gains tax obligations? Calculating your capital gains tax obligations is easy. You need to know the difference between the net sales price minus the purchase price of the asset. Then, you can plug that information into one of 3 formulas for calculating your capital gains tax obligation.